Welcome to the final reading in fixed income. This is a reading on credit strategies. This is a very important reading. There's lots to it, but this first module here, module 1, we're just going to look at revisiting the basic definition of credit risk and think about how credit spreads behave in different sectors and over the economic cycle. So first up, let's revisit the basic definition of credit risk. In its narrowest form, credit risk is the risk that a borrower, that's an issuer of bonds, fails to make good on its obligation to make the payments that it's promised under the bond. So that's it's essentially a default on their obligation, on their loans or on their bonds. As we move into credit risky sectors, we start looking at companies that can default rather than governments, which technically can't default if they can create their own currency. That's why we view them as relatively risk-free in nominal terms. But as we move into the corporate sector, we see smaller issuers, i.e. companies are smaller than governments, with smaller bond issues that trade less frequently. So liquidity risk is more of a concern, and there's a major risk of the bond market in general. You do get illiquid sovereign bonds, but more so in the corporate sector, you'd expect liquidity risk to be an issue. Liquidity risk, of course, is the risk that you can't buy or sell the bonds without giving a significant concession to the other side. In other words, you can't buy without paying up, or you can't sell without selling down. Okay, this credit risk definition, the risk that we suffer default by the issue of a bond, if we want to measure this credit risk, assess its a level if you like, we're going to need to think about the components of credit risk. So the basic ingredients of credit risk are probability of default. That's a periodic probability that the issuer defaults on a payment. So it might be annualized, for example. We're also going to need to know our expected loss given default. So loss given default is, as the name suggests, how much we expect to lose given that there's a default. Remember, with bonds, when a company defaults, chances are the issuer will be liquidated, assets will be sold, and you might well, and you usually do, get some of your par value back as a bondholder. So actually, loss given default is a function of the recovery rate. If, for example, you get back 20 cents on a dollar's worth of par, then loss given default would be 1 minus that, 1 minus the recovery rate, which in this case would be 0.8. Still a significant loss, but not 100%. So these two numbers here, if you combine them together, you get your expected credit loss on a periodic basis as a percentage, really as a decimalized percentage. Okay, if you want to work out your absolute or dollar expected loss, then you need to scale that up by your expected exposure. So take your probability of default, multiply by your loss given default, and then multiply through by your expected exposure at the point of default. Now, we're not going to do calculations explicitly on those little relations that are on the screen here, but the reading does talk about an approximation for the spread of an issuer, and it's a very intuitive approximation. The spread that you should demand from an issuer, it really should cover you. This extra return should cover you for your credit losses. Okay. That's only fair. So if you think about it, your periodic credit losses as a percentage or as a ratio, if you like, of your wealth, as a fraction of your wealth, we've just defined as the probability of default multiplied by the loss given default. So this is a way of quickly approximating where spread should be. It's just the product of the probability of default and the loss given default. It is an approximation. In fact, as we see later on, when we think about calculating your access return to credit investments, credit risky investments, there's a little bit more to it than that. But for now, the reading says you can estimate spread by just saying you need to make back your periodic loss, which is probability of default times loss given default. By the way, if I rearrange this, I can estimate the probability of default. In the text, it's sometimes referred to as POD, so you might see that. All right, that's going to be approximately, if I rearrange this, your POD is going to be spread over loss given default. Okay, so you could use that as well. For me, that's less intuitively obvious than this first one here. So that's the way I choose to, that's not remember it, but that's the understanding route into this, the first one. And then you can rearrange it to get the probability of default. Let's have a look at an example of an application of these basic relationships, or using them. You've got here a credit analyst that notes that an issuer has first lien. So that's a lien is a legal term for seniority. First lien is more senior than second lien. And you can see here we've got some first lien bonds with a spread of 1.5%. So we'll call that S1. The historical recovery rate for similar first lien bonds is 50%. So I'll call that recovery rate 1. And that does imply that the loss given default of these first lien bonds is 1 minus a half, which is just a half again. Okay, so same number, but just a different concept. Loss given default is not always the same as recovery rate. Obviously, it's 1 minus the recovery rate. The issuer is preparing to issue second lien bonds, so less secure bonds, bonds whose investors have to wait until the first lien bonds are paid back in liquidation before they get any access to collateral, proceeds from selling collateral. The historical recovery rate on similar second lien bonds is 40%. So that's the recovery rate of second lien bonds, which implies a loss given default on these second lien bonds of 1 minus that recovery rate. In other words, 0.6. Now, the thing that's missing from this page is probability of default, isn't it? And the trick here is to go through probability of default to get this fair credit spread for the second lien bonds. Because, of course, the fair credit spread for the second lien bonds, as we've already said, would be the probability of default of the issuer multiplied by the loss given default of the second lien bonds, which we've already got. So we just need to get the probability of default of the issuer. And the trick here is to realise that the probability of default of the issuer is independent to the class of bond that you're looking at, whether it's first lien or second lien. And we can use the first lien information to back out the probability of default of the issuer, and then use that to derive what the fair spread for the second lien debt must be. In other words, we know that the spread for the first lien debt must be the probability of default of the issuer multiplied by the loss given default for the first lien debt. I can rearrange that like we did off slide and say, therefore, the probability of default of the issuer is the first lien spread over the first lien loss given default, which we know to be 1.5% divided by a half. All right. Now, I'm going to work in whole percentages. If you're in doubt, put decimals in, you'll get decimals out, you'll be fine. But I happen to be okay just thinking about scaling a whole percentage up or down by a number. Essentially, I know I'm going to maintain, it's going to be okay, and I'm going to come out in whole percentages. So that's 3%. When I divide 1.5 by a half, I'm essentially multiplying it by 2 and I get 3%. So that's the probability of default of the issuer. What I can do is now use that in here. All right, the spread for the second lien debt, it must be 3% multiplied by the loss given default for the second lien debt, which is 0.6, and that's how I get 1.8% as a fair spread for the second lien debt, second lien issue. All right, so there will be some solutions on the next slide here, which are really just reiterating what we just did. But I thought, the story told itself here, really, so I didn't bother. They should be saying the same thing. They are, yeah. So probability to default 3%, and therefore credit spread of the second lien debt 1.8%. Okay, the curriculum now turns to a discussion about how the credit spread should behave over the economic cycle. So this isn't, even the curriculum itself says that this is a stylized summary. In other words, what they're saying here is a kind of a theoretical discussion. In practice, no two credit cycles are the same. This is the credit cycle here, how credit spreads behave over the economic cycle, which is here. All right. Economic cycle links to activity. So you have, after a recession where there's a contraction in activity, you'll have an early recovery, an early expansion, and then you'll have late expansion where we might get overheated and we peak and then start falling again. That's the economic cycle linked to the kind of the animal spirits of over exuberance and over pessimism and malinvestment along the way. So how would we expect credit spreads to behave across this cycle? Well, like I say, even the curriculum says, every credit cycle is different, and this is a stylized analysis. Well, we'll just focus on what the key takeaways are here, I think. Credit spreads are related to, spreads really are related to corporate defaults, okay? Spreads will be higher when there's more risk. As we've already said, spreads are broadly linked directly to probability of default and loss given default. So spreads will be higher when there's a higher probability of default and there's higher loss given default. In other words, in the bad times, when there's corporate defaults, all right, obviously there's a higher chance your issuer will default when they're peaking, and there's a bigger loss given default. So spreads will be higher in the bad times, and that's kind of stating the obvious. But be careful, because spreads, of course, are based on a market price, and market prices can be forward-looking. You'd actually expect spreads to peak during a recession, and you'd want to be positioning yourself and taking exposure to credit risky instruments when credit spreads stable and before they start falling. So you're going to buy credit, actually. When I say buy credit, I mean invest in credit risky names. You're sort of at the end of a recession, at the start of an early expansion, okay? And that might seem crazy because corporate defaults are peaking here, but really the spreads are looking forward a little bit, and they're seeing that, corporate defaults are going to fall, and so spreads stabilize and start falling as the economy moves into later expansion. Okay, so you buy credit here, spreads fall, and the idea is you want to get out before we peak. So when the slowdown starts happening and the market starts factoring in a recession, you want to get out before we start pricing in this peak here. And even though corporate defaults haven't picked up yet, once again spreads are looking forward and thinking, well, we're peaking, next thing is a down move, so spreads are starting to rise here. So you'd sell credit here just before spreads rise, okay, and they peak when we're in recession. You'd be looking to get back into credit markets at the end of a recession or the start of an early expansion. So that's one dimension to the credit cycle. The other dimension talks about slope. So what is this slope thing? Well, they're talking here about the slope of the credit curve. Now, the credit curve is really just like a yield curve, but for spreads instead of yields. It's a plot of maturities, versus rates. And here, the rate is actually a credit spread. So for a particular class of bond, we could plot what the spread is for a particular type of issue versus the maturity. Like, for example, we could take AA bonds that are rated AA, and we could see that spreads tend to be higher for longer dated maturities. Now, that's an upward sloping curve, and we saw that yield curves are normally upward sloping. It turns out that credit spread curves are normally upward sloping as well. At least they are when the economy is doing well. It means that the chance of near-term defaults is relatively low, but longer down the track, it might pick up a bit. Further down the track, it might pick up a bit. So this is why we see upward sloping curves when we're having a late expansion, when we've got peak economic activity. This row here is referring to overall spread levels, but we've got a change in the shape. That's the crucial thing here. The change in the shape would be upward sloping when times are good. Actually, when we're in recession and actually still in early expansion as well, the probability of default in the near term is relatively high. So we'd expect inverted or flat for investment grade. IG stands for investment grade here. That's high quality names. So AAA down to the first B rating, triple B. So that curve is likely to be flat and maybe flat here as well. High yield curves actually tend to invert during a recession and in the early expansion stage. And that's due to the fact that probability of default is very high in the near term still and not so high later on for later maturities. So high yield, of course, is more risky, more credit risky. Generally, that relates to credit ratings of the second B rating and below. When we move into, as we move down there, we're moving to look at companies that are actually in financial distress. Now look, the key takeaway here, knowing with a bit of foresight on what we need to do later on to pick the right kind of strategy given a forecast, really you should just focus on the two key takeaways here. The first thing is that in the good times, spreads fall, all right, and as things worsen, spreads rise. Okay. So as we peak and as we move into recession, spreads are rising here. So in the good times, spreads fall. In the bad times, spreads rise. But we knew that anyway. Probably the new thing here is that in the good times, when we're expanding, we tend to have an upward sloping curve. When we have a recession, or if we're coming out of recession, we have an inverted curve. So the key takeaway is if you expect good times, then you expect to move into good times, then you would expect the credit curve slope to steepen. All right, and if you expect to move into bad times, you'd expect the credit curve to flatten or invert. Notice it's only the high yield curve that tends to invert. The investment grade curve will be flat, all right, below high yield obviously. So IG might look like that, high yield like that. IG tends to be flat. Okay, now remember that we're really thinking about how bonds behave. We're thinking about investing in bonds. And of course, bonds have a yield, which is a component of two things. Whilst we're very interested in spreads in this reading, don't forget that the yield of a bond is actually composed of a risk-free benchmark, relatively risk-free benchmark, plus that spread. So high yield names tend to be driven by this spread because that tends to dominate. High yield names are risky. And if you like, spreads are going to move by more for high yield names, and that's likely to dominate the yield of the bond, and therefore drive the price of the bond, because the value of the bond, the price of the bond is linked to its yield. For investment grade names, they're not going to have investment grade names. They're not going to have much sensitivity to spread. They'll have a little spread, but probably they're going to be more linked to the risk-free rates. If risk-free rates shift up or down, like we were saying in the last chapter, investment grade names are probably going to be driven by that component of their yield rather than spreads, because spreads is not a big deal, because credit risk is not such a big deal. Remember, if we want to measure our sensitivity to a parallel shift in risk-free rates or a parallel shift in spreads, we can always go through the relevant duration measure. That's the first component of the estimate for the price impact of a shift. A parallel shift in either rates or spreads. We've seen that before. And I think this final bullet point here is really just reinforcing something we've already said, and that is that investment grade are more driven by the risk-free rates, what that benchmark yield curve is doing, like in the last chapter. High yield names tend to be more driven by spread. And we're interested in spread, of course, because changes in spread tells us about the relative value of a risky instrument versus the benchmark, or a less risky instrument. So here we're just formally stating that yes, a bond's price is driven by changes in its yield. That yield, of course, if you strip out benchmark rates of return, you're left with the spread. The point is if spreads change, then we're saying by definition that the yield of a risky bond is moving differently to the yield of a safe benchmark. All right, and if spreads are rising, if you like, the corporate yield is rising relative to benchmarks. So if spreads are rising, the yield of the riskier instrument is rising by more, and that's going to be detrimental to the price of the risky bond, assuming they've got an overall similar duration. And duration there is like sensitivity to risk-free rates. So yes, your change in spread multiplied by spread duration, which is your sensitivity to a unit change in spread, that will give you your percentage relative value in the riskier bond, percentage change in the relative value of the riskier bond. Now, just another technical point here. At the start of fixed income, we did meet we did refresh our knowledge of all the measures, different measures of duration, from Macaulay all the way through to effective. And there was a new kid on the block there. There was empirical duration. Empirical duration is an assessment of the actual sensitivity in price in percent terms versus a unit change in rates. And here we're looking at risk-free benchmark rates. Okay, it's a regression. It's looking at sensitivity through regression based on empirical data. That's why it's called empirical duration. And what we find with empirical duration is something maybe a little bit strange until we analyse it, and then we think, oh, okay, maybe that does make sense. Empirical duration tends to fall lower than our theoretical effective duration, you know, what our sensitivity should be relative to a unit shifting benchmark rates. We're talking about benchmark rates here, sensitivity to benchmark rates. We tend to find that empirical duration is lower than what we'd expect if we just looked at the bond's effective duration, particularly if we move out into lower credit quality names. You know, if we move into high yield names, the empirical duration is, you know, much lower than the theoretical effective duration. In other words, bonds aren't as sensitive to changes in benchmark rates as maybe duration measures would suggest when we apply them to benchmark rates. In fact, as we move right down into the the really credit risky area of the C's, you know, when you move into a credit rating with C's in it, you're looking at companies that are likely to default. It's not like if conditions worsen, they could get into trouble, or, you know, if there's a big crash or something, they could. No, these companies are already pretty much in trouble, and chances are it's either possible or probable that they, significantly possible or probable they're going to default. And we find here we get a negative empirical duration. Negative. So what's that all about? Well, it's linked to the fact that risk-free rates and spreads tend to move in opposite directions. If you think about it, when the economy is improving, central banks will be removing stimulus, maybe even tightening monetary policy to try and slow the economy down. I haven't done much of that of late, and when I say of late, I mean the last 20 years or so, really. But, you know, theoretically, if things improve, the central bank should step in and tighten to stop the economy overheating, or to remove stimulus that was there in the bad times. So risk-free rates will be rising. That's a function of central bank tightening. But of course, if the economy is improving, there's less chance that companies are going to default. Companies are profitable and they're chugging along just fine, so spreads will be falling. Now, the point here is that, of course, once again, a bond's yield is that risk-free rate plus a spread. And in the good times, risk-free rates are rising, but spreads are falling. And as we've already said, for investment grade names, they're going to be largely driven by this. So for investment grade names, you know, spreads aren't a big deal. So rates, benchmark rates go up, risk-free rates go up, like treasury rates, something like that. Yield of the bond goes up and the bond price falls. So you'll have a positive duration relation. Don't forget, a positive duration relationship means actually an inverse relationship between yields and prices. Now, maybe you can sense what's coming here. As we move down in terms of credit quality, particularly as we move into high yield names down here, we find that the spread will dominate. And when the spread dominates, what we've got is a situation where risk-free rates are rising, but spreads are falling by more, which will cause the yield to fall for high yield names, which will cause their price to rise. So what have we got? We've got risk-free rates going up and risky bond prices rising because their spread is contracting by more. Now that is a direct relationship between benchmark rates and prices, and that would be reflected as a negative duration. Once again, I'll just re-emphasize the fact that positive duration means you've got an inverse price rate relationship. If you've got a positive duration, you've got a direct price rate relationship, and that's happening here because the spread is dominating for high yield names and the spread is falling when the economy improves. Okay, well that completes module 1 of the final reading, the credit strategies reading in fixed income.